You ever scroll through crypto news, right, and you see one coin just, it's like skyrocketing.
Yeah.
And then the next headline is about some brand new project, maybe DeFi, maybe NFTs.
Yeah,
It's a lot.
it really is. And all the jargon.
Exactly.
Ugh.
But underneath all that hype, there's this, like, economic engine, isn't there, making it all work. Tokenomics.
That's the one, tokenomics. It's
Yeah.
really not just about watching price charts wiggle up and down.
Yeah.
It's the fundamental economic design, the blueprint for how a crypto coin or a token is supposed to function, and crucially, how it plans to, build and hold value over time.
Okay, let's really unpack that today because we're diving deep into tokenomics. We've pulled together a whole bunch of different viewpoints for you. Stuff from crypto exchanges, some pretty detailed research reports, what the crypto news sites are saying, and even opinions from a Reddit thread. Pretty wide range.
Yeah, getting the full picture.
Our mission here is basically to piece all that together and give you a really solid understanding of what tokenomics actually is.
Yeah, the aim is to arm you with, let's say, a foundational grasp of tokenomics. We want to break down the key bits, explain why they matter so much.
Right.
So whether you're just curious or you're maybe trying to figure out if a project has legs long term, understanding the tokenomics gives you a much better lens to look through. We're hoping for a few of those aha moments,
Yeah, I feel. Okay, so let's start right at the beginning. In a nutshell, what is tokenomics?
Okay. So at its core, tokenomics is all about the economic rules governing a cryptocurrency or a token.
Uh-huh.
That means everything. How it's created, how it's distributed, what you can actually use it for, and its overall role in its little digital economy. It's basically the study of the token's economy itself.
Okay, and just so we're super clear, because people often mix them up,
Right.
what's the difference between a cryptocurrency and a token in this context?
Yeah, good question. That's a really key distinction. Cryptocurrencies, think Bitcoin, Litecoin, they run on their own blockchain, their own infrastructure. Tokens, though, they're built on top of existing blockchains, like Ethereum is a big one, or Binance Smart Chain. Tokens are more like applications running on a platform someone else built.
Okay, that makes sense. So why is getting a handle on these economic rules so important?
Well, what's really interesting is how good tokenomics can sort of align everyone's interests, the developers, the investors, the actual users. It's a huge factor in whether a project can create value that lasts. Good tokenomics helps build a strong community. You can give clues about how the market might behave, and ultimately, it really helps the project succeed and stay stable.
Makes sense. So what are the building blocks then, the key parts of tokenomics we need to watch out for?
Okay, there are several core pieces. Let's start with token supply. Simple idea, really how many tokens are there or will there ever be?
Right.
And within that, we usually talk about circulating supply. That's what's out there available to trade right now. And then total supply, which is every token ever created, even if some are locked up or waiting to be released.
Okay, and we hear a lot about fixed supplies, like Bitcoin's famous 21 million limit, versus tokens that can just keep being made. Unlimited supply.
Yeah.
How does that difference play out in the tokenomics?
Well, think basic economics, right? Scarcity often boosts value. So a fixed or capped supply, like Bitcoin, creates that scarcity. If more people want it over time, that limited supply could push the price up. It's like a built-in pressure cooker for demand, almost.
Right.
If adoption grows and there are no new coins being made, people have to compete for the existing ones. That can mean faster price increases, but maybe more volatility too.
And the unlimited supply ones,
Yeah.
like Dogecoin.
Those don't have that built-in scarcity, so there's a risk of ongoing inflation, more and more tokens coming out, potentially watering down the value of the ones already out there.
So is an unlimited supply always a bad sign? A big risk?
Not necessarily, no. Some projects are quite clever about it. They build in ways to manage that potential inflation. Ethereum's a good example. It doesn't have a hard cap, but they brought in EIP 1559. That change automatically burns some of the fees from transactions.
Burns, as in destroy it.
Yeah, removes them from circulation permanently. So that helps control the inflation. It's more about actively managing the supply rather than just relying on scarcity.
Interesting. So it's like active monetary policy versus passive scarcity.
Exactly. That's a good way to put it. Deflationary tokens, with the caps, they bank on scarcity increasing value. But like we'll probably get into, the crypto market's wild swings can still mess with that.
Okay, supply check. What's the next piece of the tokenomics puzzle?
Next up is token distribution. How did the tokens get out there in the first place?
Right, like who got them initially?
Precisely. Was it an ICO, an initial coin offering? Or maybe an IEO, an initial exchange offering where an exchange handles the sale?
Uh-huh.
Airdrops are another way, just giving tokens away to lots of people. Stellar did a big XLM airdrop back in 2018, for example.
And why does that initial distribution matter so much?
Well, you want to know who got the tokens and how many. It's pretty normal for the team, advisors, early investors to get a chunk,
Sure.
but you really want to look for vesting schedules. That means their tokens are locked up for a while.
Ah, so they can't just dump them all at once.
Exactly. It prevents a sudden flood hitting the market, which could crash the price. Transparency about who got what and when they can sell, that builds trust.
Okay, so we know how many tokens there are, who got them first. Now, what are they actually for? That brings us to token utility, doesn't it?
It does. Utility tokens basically give you access to services or products within that specific project's world.
Like what?
Could be paying transaction fees on their network, maybe unlocking special features on a platform. The key is the token's value is often tied directly to how much people want or need those services.
So it's not just what it does, but how necessary it is.
Exactly. How fundamental is it to that ecosystem? Could it be easily replaced? A really valuable utility token becomes essential, creating real, ongoing demand.
Can you give us an example?
Sure. Think about UNI. That's the token for Uniswap, the big decentralized exchange.
Okay.
The more people use Uniswap to trade or provide liquidity, the more demand there is for UNI. Why? Because you use UNI for governance, voting on the platform's future, and you can earn rewards with it too.
So the success of the exchange itself drives demand for the token.
Precisely. It's like needing a ticket for an amusement park. You need the token to participate in that specific digital world.
Makes perfect sense. But not all tokens are utility tokens like that, are they?
No, definitely not. You've got governance tokens, which we just touched on with you and I. They give voting power. Then there are security tokens. These actually represent ownership in real-world things like company shares or maybe part of a building. They're heavily regulated.
Right.
And then you have something like Bitcoin, which most people see mainly as a store of value, like digital gold.
Okay, so supply, distribution, utility.
Mm-hmm.
What other key mechanics should we know about?
Let's talk about token emission and minting. That's just the fancy way of saying how new tokens are created.
Like mining for Bitcoin.
Exactly. In proof-of-work systems like Bitcoin, miners solve these hard math problems to validate transactions, and boom, they get rewarded with new Bitcoins.
And proof of work means?
Proof-of-work is where network participants, the miners, use computing power to solve those puzzles. It secures the network, but uses a lot of energy.
Okay. And you mentioned Bitcoin's halving.
Right. That's an event programmed into Bitcoin that happens roughly every 4 years. It cuts the reward for miners in half, slowing down the creation of new Bitcoins.
Got it. So that's creation. What about the opposite? You mentioned token burning earlier.
Yes. Token burning. It sounds dramatic, doesn't it?
A little bit.
It's basically deliberately destroying tokens, sending them to a digital wallet address that nobody can ever access a burner address.
Why would anyone do that?
To reduce the total supply, by making the tokens scarcer, it can potentially push up the value of the ones that are left. Binance Coin, BNB, does regular burns based on how much trading happens on their platform. Many think that's helped its price.
Huh. Counterintuitive, but I see the logic now. Okay, what about staking? Hear that one all the time, too.
Staking is mainly for proof-of-stake systems.
Which are different from proof of work.
Yeah. In proof-of-stake, instead of miners using computing power, participants lock up their existing coins, they stake them to help secure the network and validate transactions. It's generally much more energy efficient.
Well, okay, so what's the incentive?
Stakers get rewards, usually more of the same token, for locking up their coins and helping out. This encourages people to hold onto their tokens long term, and since those staked tokens aren't actively trading, it reduces the circulating supply.
Potentially pushing the price up?
Potentially, yes. It can create some upward pressure.
All right. And the last fundamental big you mentioned was liquidity.
Liquidity, super important. It's basically how easily you can buy or sell a token without drastically changing its price.
So if it's hard to sell without the price tanking.
That's low liquidity. It's risky. Even a medium-sized sell order could cause a big price drop, making it tough for people to get out without losing a lot. High liquidity means a healthier, more stable market for that token.
And how do you gauge liquidity?
Trading volume is a big one. How much is being bought and sold? Also, how many different exchanges list the token? More listings usually means better liquidity.
Okay, wow. So all these things, supply, distribution, utility, making new ones, burning old ones, staking, liquidity, they all kind of weave together.
They absolutely do. It's the interplay between all these internal tokenomic factors plus external things like market buzz, actual adoption, tech improvements, partnerships. All that shapes the demand for a token.
Right. News hits, people get excited, demand goes up, or
Mhm.
the opposite.
Exactly. It directly impacts the price.
This is really helpful for breaking it down. It feels less chaotic now. You mentioned inflationary versus deflationary models earlier. Can we dig into that contrast a bit more?
Sure. So think traditional economics first. Inflation. More money chasing the same amount of stuff so your money buys less. Deflation. The opposite, prices fall.
Okay.
Those ideas apply in crypto too. A token with no supply cap, generally inflationary. New tokens keep coming, potentially diluting value if demand doesn't keep pace.
But you said they can manage that
Right.
with burning.
Right. Mechanisms like burning can counteract that pressure. Deflationary models, though, with their fixed caps and maybe even burning, aim for increasing scarcity over time. In theory, that's good for long-term holders because their slice of the pie gets bigger, relatively speaking.
But there's always a but in crypto, isn't there?
Pretty much. You mentioned volatility. Even with a perfect deflationary model on paper, the overall crypto market can just go wild for reasons totally unrelated to that specific token's design.
So deflation isn't a magic bullet.
Not at all. And conversely, inflationary models, while they have that devaluation risk, they can offer more flexibility for the project to manage things if they do it smartly and transparently. It really comes down to whether the whole economic system is well-designed and sustainable.
Okay, that clarifies the trade-offs. So, knowing what good tokenomics might look like, what are the big red flags? What should make us pause when looking at a project?
Good question. Definitely be cautious about unlimited supply if there's no clear plan, no effective mechanism to control inflation or burn tokens.
Yeah.
Also, watch out for potential supply shocks. That means huge amounts of locked-up tokens suddenly becoming available to sell, maybe because a vesting period ends, or if they just change the rules about unlocking tokens unexpectedly, that can hit the price hard.
What else?
Low liquidity, we talked about that. If it's hard to trade, that's a major risk.
And what about the people behind the project?
Hugely important. If the team isn't credible or transparent, especially if they're anonymous, how can you trust them long-term? Big red flag.
Yeah, makes sense.
Also, beware of too much centralization. If the core team or a small group controls most of the tokens or all the decision-making power, that's risky. They could manipulate things.
And lack of info.
Absolutely. Poor transparency and documentation, like a really vague white paper or no white paper at all, code that you can't even look at because it's closed source, that makes it impossible to really check their claims about the tokenomics.
Really practical list of warnings there. Okay, so thinking about all these economic rules, how do people even try to figure out what a token should be worth? Valuation.
Valuation. That's the million-dollar question, sometimes literally. It's tricky, still evolving. There's no single perfect way like with stocks.
But what are the approaches people use?
Well, one is looking at utility. How useful is the token? How much demand is there for what it does within its ecosystem? If it unlocks a super valuable service lots of people want, you could argue it has higher intrinsic value.
Like the UNI example again.
Exactly. Then there's market-based valuation, basically comparing it to similar tokens. How does its tech, its utility, its market performance stack up against comparable projects? Look at trading volumes, liquidity, too.
Okay. Any more like financial style models?
Yeah, people are trying to adapt traditional methods. Some try a discounted cash flow, DCF model, especially for platforms like Ethereum.
How does that work for crypto?
Well, you try to forecast the cash flows, things like transaction fees the network earns or staking rewards paid out. Then you discount those future earnings back to today's value. It's complex, lots of assumptions involved, but it's an attempt to find a fundamental value.
Interesting. What about data from the blockchain itself? Can that help?
Definitely. On-chain metrics are super useful for relative valuation, looking at things like the number of active addresses, kind of like user growth, or total transaction fees being paid on the network, or the total value locked, TVL, in DeFi protocols built on that chain. These give you a sense of real activity and demand.
So you could compare, say, Solana and Cardano on those metrics.
Exactly. You could look at something like their price to fees ratio. Are users paying a lot in fees relative to the token's price? Maybe one looks overvalued compared to the other based on that specific metric.
So lots of different lenses to look through.
Yeah, no single magic number. Supply-demand basics, complex financial models, on-chain data, they all try to answer. Is this price justified? You need to look at multiple things.
Okay. Now, you mentioned looking at a Reddit thread, too. What was the vibe from the community on tokenomics?
It was interesting, a lot of emphasis on how crucial both the team and the tokenomics are for success or failure.
Any specific examples?
Algorand came up a few times, people saying, potentially great tech, but maybe the tokenomics weren't ideal, at least initially.
Mm.
And lots of different opinions on who has the best tokenomics, Bitcoin, Ethereum, naturally, but also names like Ergo, even Reddit's own Moons token popped up.
Moons, this is cryptocurrency sub.
Yeah, though there was definitely some skepticism there, particularly about tokens like Moons and Bricks that just keep inflating forever.
Ah, the unlimited supply issue again.
Right. Another interesting point was about projects with maybe strong fundamentals, but they don't do the usual crypto marketing hype. Quant QNT was mentioned as maybe flying under the radar because of that.
So substance over style, potentially missed.
Could be. But the big takeaway from the community chatter was really just understanding what tokenomics means. Going beyond just supply is absolutely vital if you want to be involved in crypto seriously.
That's a solid point. It's the whole system. Okay, you also wanted to mention yield farming. Tokenomics specifically, big trend in DeFi.
Yeah, absolutely. So yield farms, right? They lure you in with often crazy high APYs.
Oh yeah, seen those percentages?
The way they usually pay those yields is by giving out the farm's own native token. But here's the catch. That's often inflationary. They're minting new tokens to pay rewards.
So more supply hitting the market.
Exactly, which often leads to the price of that reward token dropping pretty fast, especially early on. People call it the farm and dump sometimes, particularly if the token doesn't do much else besides being a reward.
So those high yields can be a bit deceptive if the token itself loses value.
Precisely. It's a key tokenomic challenge for those projects. But the successful ones find ways around it.
Wow.
They add utility to the token. They introduce deflationary stuff like burning mechanisms. PancakeSwap is a good case study. Their cake token took a hit initially, but then they added things like a lottery, their IFO platform for launching new tokens, stuff that used cake and burned cake. That helped it recover.
So they gave the token more reasons to exist, basically.
Exactly. Evolving the tokenomics.
Fascinating how these things adapt. Now, switching gears slightly, you also looked at Stripe's view, the big payments company, on token pricing for businesses. What did they say?
Stripe saw potential benefits for businesses using tokens,
Oh.
things like easier cross-border payments, maybe new income streams from staking or governance fees if they build an ecosystem.
But challenges too.
Oh yeah, big ones. Finding that sweet spot between making the token scarce enough to have value, but accessible enough for people to actually use it, that's tough. And ensuring there's enough liquidity so it's not volatile and unusable.
So what was Stripe's advice for businesses thinking about this?
Their recommendations were pretty practical. First, focus on real utility. Don't just rely on hype.
Makes sense.
Carefully control the supply, but don't choke off growth. Aim for predictable pricing if you can. Build user trust. Actively build liquidity from the start. Get listed on exchanges. Maybe incentivize liquidity pools.
Sounds like solid business advice applied to tokens.
Pretty much. Also, design for the long haul. Think about regulatory risks up front and see the token's pricing not just as a number, but as a growth engine to attract and keep users by giving them real value.
Very pragmatic take. Okay, lastly, you touched on some more academic or research-focused ways of analyzing tokenomics. What's happening there?
Yeah, things are getting more sophisticated. For looking at the small scale, the micro-tokenomics, like how incentives work inside a network, researchers are using things like agent-based modeling. Credo apparently used this to simulate how users might react to different incentives.
Like running simulations of the token economy.
Kind of, yeah. And for the bigger picture, the macro tokenomics, the overall design, long-term viability, they're using structural and mathematical models, sometimes drawing on existing economic theories like Vitalik Buterin, applying the quantity theory of money. Projects like DOT and Kimlik were mentioned as using these for forecasting.
So trying to build more rigorous models for predicting value and stability.
That's the goal. And adapting traditional finance tools, too. We mentioned discounted cash flow being tried for Ethereum, treating fees and staking like revenue.
Right.
There are also network effect models, like Metcalfe's law, the idea that a network's value grows exponentially with the number of users. People apply that to Bitcoin and Ethereum, leading to metrics like the NVT ratio, network value to transactions.
Trying to value the network itself.
Exactly. Some even try a cost of production model for Bitcoin, like valuing a commodity based on mining costs, or the total addressable market (TAM) approach, trying to guess Bitcoin's potential value by comparing it to, say, the gold market or global remittances.
Lots of angles.
For sure. And then there are specific on-chain metrics just for Bitcoin, like the MVRV ratio, market value to realized value, which tries to gauge if the market is overheated or undervalued compared to the price holders originally paid.
Wow, okay, so the analysis is getting seriously deep and data heavy. Now, we had that image associated with the sources, the cracked ice over dark water. How does that connect back to tokenomics for you?
I thought that was a great metaphor, actually. You look at the crypto market, right? The surface looks like that cracked ice, fragmented, sometimes chaotic, prices shooting up and down unpredictably.
Yeah, definitely feels like that sometime.
But underneath that volatile surface, there's a structure. There's the deep water, the underlying reality. And that's the tokenomics. If you understand the ice, the water, the physics, the tokenomics, you can start to make sense of the patterns on the surface, even when it looks messy. It's about understanding the fundamentals beneath the price action.
Great analogy.
Yeah.
Okay, as we wrap this up, what's the absolute core message you want people to take away about tokenomics?
I think the main thing is tokenomics matters. Fundamentally, it's not just some techie detail. It's the economic heart of a crypto project.
Right.
Getting a decent grasp of these key ideas, supply, distribution, utility, all those mechanisms we talked about, it's just essential if you want to navigate the space smartly. It's way more than just looking at a price chart and crossing your fingers.
Couldn't agree more. This has been incredibly insightful, really helped clarify things. So, thinking about all this, a question for you listening. Now that you've got this deeper view of these economic engines, what specific tokenomic models or maybe what red flags are you going to pay more attention to when you look at a project? And, how might knowing this stuff change how you think about the long-term potential in this wild, evolving crypto world? Definitely something to mull over as you keep exploring.